Students, various authors over a number of years have used various terms to highlight the underlying theory of accounting. Now these terms were concepts, conventions, principles, etc. Now all these terms have been used interchangeably by various authors, by various institutions and so on. So in this chapter we are going to study them under a common name of accounting concepts. The first accounting concept that we are going to start is business entity concept. Now business entity concept. What does this concept tells us? This concept clearly states that the business, as far as the accounting part is concerned, has a separate identity from the owner of the business. That is, from accounting viewpoint, the business has a separate identity. The owner is the creditor of the business to the extent of his capital. To the extent of his capital. No personal transactions of the owner can be mixed with the business. That is, if we want to ascertain the correct financial position of the business, the personal transactions of the owner should not be mixed with the transactions of the business. The next concept is money measurement concept. As per this concept, only those transactions which are expressed in terms of money or are capable of being expressed in terms of money are recorded in the books of accounts. That is, transactions in terms of money are recorded. Any event which cannot be expressed in terms of money, howsoever important it may be for the business, should not be recorded in the books of accounts. Now, what is the basic idea behind it? The basic idea is that money serves as a common denominator. Money is a common denominator for calculations. Now students, let's say you purchased land. The land would be measured in terms of acres or bighas or whatever the units. Then you purchased car. Car would be measured in terms of units. Now if you want to add land to car in physical terms, it is not possible because their units of measurements are different. But when we convert them into money, the money becomes a common medium for their calculations. So when we take in the form of money, it becomes a common medium in terms of calculation, and which will actually tell us about financial position. It will make it easier for accountants to actually do calculations and for the people to understand them. So only those transactions which are in terms of money are recorded. Any event which cannot be in terms of money is not recorded in the books of accounts. Let us take an example to illustrate this point also. Take an example. In a business, the production manager has a fight with the workers. Now, this is a potentially dangerous situation. It can lead to strike in the factory. But fight itself has no monetary value. Since the fight cannot be expressed in terms of money, it cannot be recorded in the books of accounts. So, only those transactions which are in terms of money are recorded. The next concept is accounting period concept. Now students, the activities, the transactions in a business continue on a regular basis. They don't stop. So now, if we want to calculate the profits and losses of the business, it requires certain time intervals at which we can calculate, or we should rather calculate. So this concept states that the accounting life of a business should be divided into smaller units, and each unit is called as accounting period. Now this period normally is of 1 year, but in some cases it can extend or it can be reduced than the prescribed 1 year period. Why is it necessary? Now students, the owners or the interested parties in a business would like to know what the business has achieved after a certain period of time. So if we want to actually get the true picture of the business, the life of the business should be divided into smaller units and the results should be calculated for each period. The results should be calculated for each period, and each of these periods is called as accounting period. Normally it is for 1 year. Like in India, by law most of the companies prepare their accounts for financial year, that is from 1st April to 31st March next year. This is one accounting period for the companies who are doing business in India. They have to communicate their results, calculate their profits for each time period from 1st April to 31st March. In US or in some other countries, this time period has been prescribed by law as from 1st January to 31st December. That is a 12-month period, but starting from 1st January and ending on 31st December.